3, 2, 1.
Welcome to the show.
Welcome.
All right.
We are back off the road again. Did we did the regular podcast?
We did last weekend, yeah.
Yeah, it was the one before that where you had.
I did it on my own. Yeah.
And I'm getting ready to travel again.
Yeah.
We were just talking off camera about all the travel that just sneaks up, and you realize all of a sudden you're bouncing somewhere every week, and
so
it's a little tiring.
Kind of full disclosure, the show is as of the close on Wednesday night.
Yeah.
I got a little meniscus surgery to have tomorrow, so I can get back to wrecking a little bit, and
I will be in Nashville.
Yeah.
Nash Vegas. So this is Sunday. When this airs, that's where I will be recovering.
Yeah, by then you'll be recovering on Sunday. Yeah. But yeah, a lot. So today the market was up quite a bit. It engulfed Monday and Tuesday's down days. So we'll see what happens for the rest of the week. But we'll talk about it. But until we get above 4,200 in the S&P, there's really nothing too interesting to talk about on a daily basis. On a weekly basis, we're still above that 20-week moving average line, but we'll get to that. But I got a bunch of other interesting things in the meantime.
I just noticed as I look over your shoulder at those plants, somebody's going to be like, y'all need to water your plants.
Oh, dude. Yeah, we do. Oh, no, I got to do that.
Yeah, we'll water that after
pruning.
the show. Yeah. Right. I just noticed that when I zoomed in on you. I was like, that doesn't look good.
It's not fall.
Yeah. What do you got for us?
All right. So, couple weeks, 2 weeks ago, I went to New York for the Charter Market Technician 50th Annual Symposium. And so I'm going to kind of do chunks of that over the next couple of months. And this one, we're going to take a look at Robert Prechter, who he did a presentation there on the value of pure technical analysis. So pure technical analysis is just the analysis of price, right? That's it. So all these other things, interest rates and wars and price of gold, price of oil, like all these things go up and down, and everybody says, well, if this happens, then that always happens. And he went through this whole really interesting slideshow about it's not always the case. It's not always the case that when rates go up, stocks go up, or vice versa. And he showed multiple time frames through history where it could have went either way.
Yeah.
So. So that's gonna. So we're gonna look at.
So he's pretty much a purist, right?
Yeah, he's the guy that ElliottWave.com. So he founded Elliott Wave International, and he actually founded a study, like biology is a field of study, right? It's called socionomics. It's fascinating if you get into it, but the idea is that the market leads events, not the other way around. Virtually everybody thinks that events happen and the market responds to what events do. And this whole study of this whole, field of study is around, like one of the easiest examples is like the length of skirts of women.
Yeah, I remember you telling me about this one. That's interesting.
It's a funny one, and it's kind of demonstrative of his whole thing. So the shorter skirts get, the closer you're getting to the top of a major top in the market, and it's always like that. Yeah. In 1929, you get like the Chicago clubs and stuff in 29, like super short skirts and all that. Yeah. And by the bottom in the Depression, everybody's wearing like dresses like that don't show above your ankle. Right. Like, so it colors and all kinds of mood, social mood leads where the market's going, not the other way around.
Yeah.
So anyway, this guy is a legend, and I'm gonna do a little piece of his presentation, and then I'm gonna take a look at the dollar index, which is definitely one I've been tracking, and I'm just gonna kind of give you guys a highlight about that, and then the TSP fund charts. All right. So before we get to all that, because we were just talking about this, so we had a post in the Facebook group last week, maybe early this week, and it was May 5th, actually. So this Marine, don't know if it's a male or female, but it says, I'm a Marine, retiring from the Marines this month. Currently allocated 50C, 30S, 20I. I'm not planning to work for a year. We'll be taking a break. What should I do with my TSP money? Most advised to leave it there. Should I? So I thought it was interesting because it had a pretty good post reach. So 2,200 people got their eyeballs on it, 44 comments, a lot of really good comments in there. Most of them advised that, this Marine keep his money in TSP. Some talking about rolling over to a Roth or an IRA. A lot of talk about IRS early withdrawal penalty, assuming, this person isn't 59 and a half when they retire at the end of the month. There was only one comment regarding his allocation. So I thought that was kind of interesting. And then as I reread the question, I think he kind of led it because what should I do with my money? Most advised to leave it there. So it seems like the question is really more geared to should I leave it in TSP versus rollover? Do
I leave it in TSP? But we originally kind of took it in a broader sense of like, what should I do with the money in general? Right. Because leave it or move it is just one of many options that you need to look at. But
yeah. So I think there's a lot of unanswered questions in the question, so we're going to have to make a couple of assumptions. But as we were talking about it, assuming he or she is not 59 and a half, right? We were just talking about, I don't know when TSP began in the military. 2018 is when the blended retirement system began, but TSP came into the military sometime before that. It wasn't there in 94 when I got out. But so sometime after that, guys started being able to contribute to TSP. So, he or she probably has some amount of money in there. And so the question is, what do you need to do with it? Do you need it to live on? So that's the first thing. If you need it to live on, then you're going to have to pay the taxes. Basically, the best thing to do is find some other way. You don't want to use that money to live on if you're under 59 and a half, for sure, because you're going to take the IRS penalty and you're going to pay the taxes on it. So you don't want to use that money to live on. So if you're not going to use it to live on, do you roll it? Do you leave it in TSP or do you roll it into an IRA or something like that? Right. Now the ETFs are so cheap, you don't have a big advantage over TSP. If you go to Fidelity or Schwab or something like that, it's super cheap. If you just do passive ETF of index funds like we have in TSP. And the other question is, do you want to manage it yourself? And how do you want to manage it?
And to me, that was the glaring question, right? I didn't think of any of the other stuff as being that important. It is and it isn't, meaning that a 30-minute meeting with a financial planner, they'd figure that out for you. Because most of those questions are tax questions, right? Okay. How's this going to impact me tax-wise, Roth versus traditional? That has nothing to do with the stock market, right? Right. My biggest concern was the allocation, the current allocation, and what's their intent going forward is how it, is it going to be passively, is it going to be managed at all, right? Are we doing the buy and hold, or are you going to manage it yourself or have someone else manage it? If we go down the road of having someone else manage it, well, then you obviously have to go to an IRA because you can't manage a TSP account, or an advisor can't, so, I mean, that I think it's probably pretty clear as to what we would recommend in many cases, which is, first of all, you made a good point, regardless of how long they've been in the military, let's say it's 20 or 30 years, however long they went, because we didn't have the TSP and I was trying to Google it, but it's not that easy to find when it started. I recall it, but it may have been in the late 90s. Because you don't recall having access to it.
It definitely wasn't there in 95. No.
Yeah, so it must have been the late 90s. But I do remember we just didn't have matching, right? And so it made it kind of like, what's the point kind of thing. Right. But, it's the questions are, the thought I had, though, was, okay, you probably don't have a massive amount of money in there, meaning like $1 million or something, right? I mean,
probably not. I mean, maybe
$250,000 is still a lot of money.
Sure. Yeah.
So let's just say it's $250,000, right? $250,000. Let's say they've done well, and really maxed it out or whatever. That's still a pretty good chunk of money, right? And you can do a lot with that because you've got your snowball going, right?
Definitely.
And so just first and foremost, just leaving it anywhere and not managing it is a scary idea.
Yeah,
because
especially the way the market is right now.
Yeah, looking at the CS&I allocation that they have, there's a good chance that could, you just sit there. I think you said, like, are you just going to watch it go down?
Right.
Like, don't do that. So first, I would find an advisor, find an RIA that is a fee only, whatever. Just go find somebody that you think you trust and have them give you some advice. You definitely need a financial planner, which you can pay them one time fee to tell you what's the best tax situation. Right.
I mean, a lot of it too. I mean, from my perspective, he says current allocation is 50C, 30S, 20I. If he's been in that allocation since the top in 2022, and is down because you got a pretty good chunk of S, which was down almost 40%.
Yeah.
But I has recovered more than both the C and S at this point. So I'd have to go back and look. If I did those percentages from the top, what would you be down at this point?
Mm-hmm.
I mean, you could always just leave it in the L funds. If you're not going away, if you're not going to work for a year, and you don't need to live on the TSP money, and say you're going to go on safari for a year or whatever, you got to have somebody that is managing it for you.
Yeah.
I wouldn't just
be out completely, like put it in G.
But this is like the best time because, I mean, the G fund is given a decent rate of return right now. My personal opinion is that rates go higher from here, not in a straight line, but they go higher, not lower. And so the G fund is only going to be more valuable over time. But leaving it anywhere is very risky right now.
Yeah, and I mean, there's also, we didn't mention this, but something that you and I both did, which is basically roll over a portion and keep a portion in TSP because you have access to it a little easier than you do in an IRA, right?
You can, but the only reason we did that is because when you retire from the government, you can withdraw that money from TSP tax free.
Yeah.
But so I don't know if he retires from the military. With a TSP account, can he withdraw tax free?
Yeah,
or not tax free, but without the IRS penalty.
Yeah, I don't know. We have to look that up because this whole thing about the military having the TSP is kind of it's not new, but it is because 2018, now everybody has to, and it's just kind of been this cloudy thing that nobody really we know. Most of us know the answers when it's on the civilian side,
right.
But I was assuming the same thing. I was assuming that he's retiring, so he can have access to his TSP, which is why we would leave.
Leave it in TSP.
Yeah, not that we're making that recommendation, but that it's one that a lot of people don't think about. Right. Like it's not an all or nothing, right? If you have, let's just say you have $250 and you're like, I'm going to leave, $50,000 or $75,000 in my TSP for emergency because I can get access to it.
Right.
If you can get access to it, because you're right, I don't know, but because it's nice to be able to have access to a chunk if you need it for whatever reason.
That's what I did exactly.
Yeah, and then you put the rest over in an IRA where you can where the gloves come off and you can manage it if you want to manage it, or you can hire someone to do it and they'll manage it for you. Yeah.
That's a big question that I wish I could answer, and maybe I'll go back and find the answer because I really kind of want to know that. But if you can
withdraw,
now you obviously have to pay the tax,
right?
But if you don't have to pay the IRS penalties,
right?
Then you can live on it.
Yeah.
Just like a retirement income. So, hopefully that gives you some thoughts about what to do.
Maybe we just made it muddier. Who knows?
Yeah. Well. All right. Robert Prechter, we talked about him, and the title of his presentation was "The Value of Pure Technical Analysis." So I'm only going to do three things: interest rates, war, and whether Democrats or Republicans are in the White House. Okay. So interest rates. This was the Dow Jones Industrial Average. So this chart right here is the Dow Jones Industrial Average from during the financial crisis, from 2007 to 2009. So everybody right now is talking about, they're on the edge of their seats. As soon as the Fed pivots, cuts rates, the market's going to skyrocket higher, right? That's what everybody is expecting right now. And if you look at a chart from October 07 to March of 09, the rates were 4.76, and I can't remember if it was Bernanke or who was in the the Fed seat at the time, but Fed funds rate consistently go lower, and so does the stock market. So that's not what people are expecting to happen right now, but that's an example of when stocks go down, when rates go down. And here's one when stocks go down but rates go up, right? So from the 73 to 74 bear market, Fed funds start down here at 5.94 and end up at 10.06. Stock market's going down, Fed funds rate is going up. So he had other charts, and I only use these couple for an example, but there are times when, the stock market's going up and rates are going up and vice versa. So every possibility can be accounted for. So basically what he's saying is you cannot hang your hat on interest rates as the determinant of whether or not stocks are going to go up and down. Okay, war. So you would, I think, intuitively expect when we go to war, stock market crashes, right? You would just kind of expect that, right? So World War II begins up here. This is actually the Dow Jones Industrial Average divided by the PPI. So we did PPI, I think, last week on the show, Producer Price Index. It's a measure of inflation. So this is an inflation-adjusted Dow Jones Industrial Average. So when the Dow versus PPI is going down, it's to your purchasing power, right? So it's not really a chart of the Dow Jones. It's a chart of the Dow Jones relative to inflation. But here we are up here when World War II begins. The value of the Dow relative to inflation falls, and we get into the war right before the bottom, right? And then it starts going up. So when it goes up, the value of the Dow versus inflation is increasing. So you're getting more purchasing power for your investment, basically. So World War II begins, the market goes down. We get into it, and right after we get into the war, maybe, I don't know, months, not long after we get into it, the stock market starts moving up. The war ends. Not long after it ends, the market crashes. I mean, it's very counterintuitive, right? So that's World War II. Korean War, same thing, Dow versus PPI. Korean War begins, market just rockets higher. I mean, all the way through. Vietnam War, same thing, Dow versus PPI. Gulf of Tonkin, so we get in, but then it's, a year or two before the market's going up. This is going up on a pretty good percentage basis until it starts, going down. And then once we evacuate, then the market tanks, right? And then the war ends, and this is the beginning, and it starts moving higher. It's very counterintuitive, and it doesn't always go down when we get into a war. We get into it here, and the market keeps going up. We get out of it here, and the market tanks. It's not intuitive. So basically what I'm saying is you look at the whole thing going on in Ukraine, and the assumption is that the spring offensive that we haven't had yet, which is amazing to me, is going to drive stock prices one way or the other, and there's just no definitive way to say, yep, if this happens, then the market does that. And then the last one, Democrats versus Republicans. It makes me laugh, some of the comments on Facebook about Democrats and Republicans. But since 1857, the stock market's average annual gain has been approximately equal under Democratic and Republican presidents. Now, I don't actually agree with what he's saying here, but essentially equal. He's saying that average annual return under Democratic presidents over time since 1857 is 7.2%. So the average annual return when a Democrat is in the White House is 7.2%. And the average annual return for a Republican in the White House is 5.9%. So he said that wasn't really statistically significant. And I'm not 100% sure that that's not statistically significant.
Yeah.
What he did was he says at the bottom here, with 1929 to 1932 omitted, which that was a 78% drop in the Great Depression. So if you omit this section right here, right, that's what he's saying. If you take that out, then the Republican average is 7.7, and so it gets a little closer to the Democrat average. But all things being equal, going back to 1857, it's pretty close. It doesn't matter very much who's in the White House.
Yeah, it's not jarringly difficult. I mean, different, right? But it's it depends on who you are, where you think those are different. Right. Significant. What's the word? Significantly.
I mean, people have very, very strong opinions. That's what that's what he was trying to get across, and that's what I would kind of like to get across in this little.
Yeah, it's at the end of the day, it really doesn't matter that much.
Well, if you are really strongly opinionated that a thing is going to happen, mm-hmm. you end up building your portfolio that way, mm-hmm. and you might be right, but you equally could be wrong.
Right.
Because it's not always when a Republican is in the White House.
It's not a data point that you'd want to hang your hat on to make decisions on how to manage your account.
Right.
That's really the takeaway, right? Not any one of these things would you use. Now, it's again, like, it's always nice to know why, but does it matter?
Yeah, well, I think we convince ourselves that we know why.
Right.
And there will be plenty of people that in hindsight will say, well, this is because these things happen, and therefore,
you can always explain it.
Yeah.
After.
You can give it an explanation. Whether or not your explanation is actually why the thing happened, you're never going to know. It's impossible to know.
Yeah.
So, I thought that was kind of the most interesting slide of the presentation, actually. All right. So something that we do need to kind of look at is the dollar. So, and this is another kind of big. There's a whole lot of talk about the dollars crashing, and there's going to be a new world reserve currency, and like all this. That's a rabbit hole that. You can spend a lot of time on YouTube going down, but the chart, I mean, from the beginning of this new 5 wave of the big super cycle that started at the bottom in 1932, the 5 leg began here in 1982, right? When interest rates were at the high, and ever since then. Rates have come down, and the stock market has been going up, and the dollar has been going down, right? So, this is a long-term chart, right? We're going back to 1982 here. Dollar comes way down, and we had a huge move in the stock market from 82 to like 1990. We had a recession in here in 1990, and then we had this huge move up in the stock market, and also a rise in the dollar, and then a big move down. Into 2008, and then the dollar bottoms here in 2007, kind of churns sideways, and then really moves higher in 14. As you're looking at this on a long term, you have a really significant triple top up here in 2000, and so it's a little bit above 118. Let's call it 120. To me, it looks like the dollar wants to move back and retest this level in the big scheme of things. You got a move higher, an ABC. I think we see the dollar move higher. That's just kind of seems to me where the market wants to go in terms of this chart. But we'll have to see. So that's the big picture of it. If we zoom in a little bit, now we got the dollar and the I fund, EFA, in orange. Okay, this is where it kind of matters to us. Generally speaking, there's almost a negative inverse correlation between the dollar and the I fund. And we talked about this before. When the dollar is going down, the I fund is going up. Okay, so the dollar basically goes down here. This is the big move up in the I fund that we've talked about from like 2003 to 2008, the I fund way outperformed the C fund. If you were in the government back then and you're in TSP, Conan talks about it all the time. The I fund, people made a lot of money in the I fund, and then they got absolutely hammered, right? But if you were watching the dollar, as the dollar came down, the I fund was going up. When the dollar bottomed, that was the top in the I fund, right? Once the dollar reversed and started moving higher, the I fund absolutely collapsed. So there's this negative correlation, and it goes all the way along. And so we're going to kind of drill into the next one to where we are a little bit closer right now. So this is a weekly going back to here in 2021. So this is the topping formation of the I fund. And the dollar, starting right that week right there, the dollar had bottomed in May 2021 and starts moving higher, right? I fund rolls over as the dollar increases. Dollar tops out in October, which was the low in 2022 for all the stocks, but also the I fund. Dollar comes down, I fund rallies big time, right? Dollar goes up, I fund goes down. Dollar goes down, I fund goes up. I mean, it's a perfect inverse correlation. Until we get to where we are right now, which is kind of interesting, because last week and so far this week, we have a pretty big move up in the dollar. I mean, if we draw this channel right here, clearly last week, the dollar broke out of that channel to the upside. But the I fund has not rolled over. It's going sideways, but it definitely hasn't rolled over on a weekly basis. So is the dollar going to keep moving higher, which will eventually drive the I fund lower? This divergence is kind of strange to me right now, to be honest. Especially so far this week, where the dollar is up and the I fund is also up for the week so far. So it's strange. So if we go zoom in for the last one on a daily basis, you can kind of really see it, because the dollar came down, the I fund went up. We're in this kind of channel on the dollar, and we're also in this channel on the I fund. But clearly, the dollar has broken out of that channel. 1, 2, 3, 4 days. And the I fund has not made a lower low. So just based on this, you would expect the I fund to be down here somewhere, and it's not. So I don't know what to make of that exactly, but I think one way or another, it could be that the dollar just reverses and starts going back down, and the I fund keeps going up. That's a possibility, but it's something that's definitely on my radar. I think if the dollar continues higher, which I do expect the dollar to keep going higher, but we'll see.
But we don't know. Yeah. I mean, the important thing is to watch it, because you can see the negative correlation. I mean, it's obvious, yep. Right? And so just because it's always done that doesn't mean it always will. But it's right. A very high probability it will. And knowing that it does that is like half the battle, right? Just knowing that you can watch the dollar and go, okay, well, now's not a time I would be putting money in the I fund, right? If you're sitting 50% or whatever in the I fund, like that's probably not a great decision right now. Not because you're guaranteed to do well or bad. It's just you don't know. And so why would you take that chance? Right.
You definitely don't want to be putting new money in the I fund when the dollar is going up.
Yeah, it's not a good idea. And it's a simple thing to watch, right? I mean, that's what, at the end of the day, we always try to remind everyone that this is an educational program, right? We're not trying to tell you what to do.
No.
What we're trying to do is give you the tools. And this is like one of the simplest tools you can have is look at the dollar, and that will tell you whether to be in the I fund. Then you go, I fund's off the table. Now let's go take a look at the CNS, right? And that's how simple it can be, right? And these things can take you, 20, 30 minutes on a weekend after the market's closed for the week, and just, figure it out, right? Because right now, if you're looking at this, what Jerry just showed you, you want to have your eye on it, over the next few weeks. But more importantly, right now is like you said, it could roll over, and the dollar goes down. But there's just a whole lot of things pointing to that not being the case.
Yeah.
Right. And so why would you have money in the iFund right now?
Right, and it's not a timing tool. I mean, we're not saying
Right.
I'm not saying sell the iFund right now. It's just that expect it to be under pressure. That's all.
Very much so.
All right. TSP fund charts. So I did a little bit kind of broader weekly chart this time, and just to basically show a couple of things. So here's the bottom from COVID. We always talk about how this is the 20-week moving average line, and we get support, all the way along until we don't here in January, and that pretty much identifies the top. The other way to anticipate the top is that when you look at look at RSI. So this week we had a breakout and got above that 50 line in RSI, and from that point all the way along until this point, which was this week, we had some corrections, right? But we never got below 50 RSI on a weekly basis. So as long as RSI is staying above that 50 line, you don't have to worry so much about these corrections. When you break down below that 50 line, that's the beginning of when things can get bad, and it did. So price is comes quite a bit down, and we stay below that 50 line, right? And even the little pops above it, they're just not. It's not strong, right? In a bear market, you can get back up to about 60 in RSI, and then roll over again, which is what you're seeing, in all of this. RSI is a really, really important tool. And so right now, we are above that 50 line, but it's weak. MACD is, cross positive. We had one negative week here, but we're positive with MACD, but it's weak, and we're above that 20-week moving average line. So technically, we have a buy trigger in place on the C fund that happened on that week right there, but we haven't made any progress since then, and we're really banging up against this, at 4188, call it 4200, but you had a lot of churn back here at 4200, resistance or support here, support, and then a big breakthrough here. And ever since this breakdown through that level, came down, a little bit of an overshoot, came down, tested it here, resistance, all the way along. So that 4200 level is going to be really important. And what would be the worst case for us is really the 4300 level is the top in August, and 3500 was the low in October. And so this really weak recovery, I mean, we could be doing like that for a long time, which would be the biggest pain in the butt for us as TSP investors, because if you get it wrong, you can get whipsawed pretty easily on a sideways consolidation like that. So we shall see, but this is definitely not a super strong recovery. It's I fully expect it to roll over at some point here at either 4200 or 4300. If it really fakes people out, we get up a little bit above 4300, and then if it rolls over. Having said that, if we do get above that 4200 level, and particularly above that 4300 level, a ton of money is going to pour into the market. I mean, there are guys that are calling for 6,500 on the S&P by the end of the year, and it's basically based on the idea that there's so much money on the sidelines that once we get above this August high, all this money is going to come pouring into the market, and it goes up like straight up 6,500 by the end of the year. That's one possibility. The other one, of course, is we hit some significant resistance in here. There's some event, we don't get a debt ceiling resolution, or something happens, and the next big leg is down. So we will watch it and report back. S fund, very obvious head and shoulders, left shoulder, head, right shoulder, neckline. We got support. So far this week, we've bounced a little bit, but we're still below that 20-week moving average line. RSI is below 50. It's been there for quite a while, and MACD is flat as can be. So it's either going to be a great time to buy the S fund because if it has to get above here to really confirm, but if it can, you got a pretty good support level there, and it can definitely go up from there. And everybody sees that head and shoulders, so they're expecting the S fund to break to the downside, which is why there are all kinds of ways to play the game, but the way that I do it is to respond to the market, not try to anticipate it. So if I was going to anticipate this, I would be betting to the downside because that's what head and shoulders formations do. But they don't always, sometimes they fail. And I don't want to be, in my brokerage account, let's say, short the S fund until it breaks that neckline. I fund, this 74 level is a problem for the I fund so far. And the dollar is, on a daily basis, certainly it's rising. It's been rising for the last 2 weeks. We haven't had much downward movement, but the dollar is turning back up. So we'll see. I don't have much confidence in the I fund at this point. It's run much higher on a percentage basis than the C or the S fund. But we, still have a buy trigger actually as of this week, and there hasn't been a sell trigger since. This week didn't get us below RSI 50, so there is no sell trigger on the I fund, since November of last year. F fund is not doing what everybody expected, right? The idea is that the stocks were going to tank and bonds were going to skyrocket, and seemingly the opposite is happening. So far, as of this week, if it closes here, it would be a sell trigger on the F fund because we would, if it's, let's say this is Friday's close, it's Wednesday, but let's say it's Friday's close. We're below that 20-week moving average line, below 50 RSI and declining, and MACD is just about to cross down. So this, by the end of the week, could very well be a sell trigger on a weekly basis on the F fund, which, again, is not what people expected, unless you're looking at the Elliott wave count, because we've said this before. Here's the top 1, 2, 3, 4, 5. If that's the case, if this is the 5, then this should be some kind of 1, 2, 3. I mean, we should be definitely higher than this. But it would be, if this is the 5, this is the beginning of a new move higher. The other way to count it, which I think is better, is 1, 2, 3, 4, 5. And so I'm sort of contrarian, I guess, to the majority that think that stocks go down and bonds go up. I actually think we're going to continue with both stocks and bonds going down, which is what we've had since the top in January 2022. But again, that's my opinion, and that's not what I trade on.
Questions. If you have any questions, you can put them wherever you find, put them in the comment section wherever you find the video. If there's no comment section, you can always shoot us an email, support@growmytsp.com, and they'll get that over to us. Yep. We'll try to get this highlighted for the folks that were talking in that Facebook post. We need to make sure to post, when we post this show, post another link within that comment section so they sure find it. Yep. It's always a battle for us to know what's being seen versus what's not. Like last week's show, I think it took a long while to kind of kick into the algorithm or something. Yep. And then it finally got, picking up, because we normally have, X amount of views on YouTube and X amount on Facebook or whatever. And it's just so weird trying to figure out that
algorithm is a nemesis for sure.
I know. Honestly, to be honest, we don't really put a whole lot of thought in it anymore. We put the stuff out. You guys know where to find us. Hopefully you're finding us, and hopefully you're watching it, because we enjoy doing this. And so we hope you guys get a little bit out of it. Hopefully you're learning some stuff. And if you are, tell us what you learned.
Awesome.
If you like it, share it with your friends. If you don't, share it with your friends anyway. We'll see you guys next week, and we are
out of here.
Out of here.